Hello. We have a question from a trader that reads, why are U.S. aerospace and defense stocks and road and rail stocks performing better than the stocks of all other industries on the S&P 500 index this year? To begin with, I personally don't trade the specific stocks mentioned, such as those in the SPDR S&P Aerospace and Defense ETF or the SPDR S&P Transportation ETF. But as a global financial markets participant, I'll explore the macroeconomic, geopolitical, and industry-specific factors driving their performance. The S&P 500's performance in 2025 has been volatile, with recent data indicating a recovery from earlier losses. As of May 20th, 2025, the S&P 500 closed at 5,928.85, down 0.7% from the previous day, reflecting a modest year-to-date gain of approximately 0.3% from its 2024 close of 5,881.63. This follows a significant Q1 decline of 4.6%, the worst since Q2 2022, driven by tech sector weakness and tariff-related concerns. However, a tech-led rally in early May, fueled by easing U.S.-China trade tensions, helped the index erase a 15% year-to-date loss in just 6 weeks, marking its fastest recovery from such a decline since 1982. Despite this, the index remains below its all-time high of 6,144.5 on February 19, 2025. Against this backdrop, aerospace and defense and road and rail sectors have outperformed, driven by structural resilience and unique tailwinds. Macroeconomic environment. The global economy in May 2025 is navigating a complex landscape. The Federal Reserve has maintained interest rates at 4.25% to 4.50% since March, reflecting caution due to tariff-driven inflation risks. Federal Reserve Chair Jerome Powell has emphasized the need for greater clarity before rate adjustments, as tariffs could push inflation above the 2% target. This high-rate environment pressures growth-oriented sectors like technology and consumer discretionary, which rely on cheap borrowing. In contrast, aerospace and defense and road and rail benefit from stable, non-cyclical demand. Defense spending is largely immune to economic cycles due to long-term government contracts, while transportation services are essential for logistics and freight, sustaining demand even in slower growth periods. The S&P 500's forward P/E ratio of 19.8, below its 5-year average but above its 10-year average, signals high valuations that make defensive sectors more attractive to investors. Geopolitical tailwinds for aerospace and defense. Geopolitical tensions are a key driver of the aerospace and defense sector strength. Global defense spending is projected to grow at 5% annually through 2030, driven by conflicts in the Middle East, Russia-Ukraine tensions, and strategic competition with China. The U.S. defense budget for 2026, proposed at $1 trillion, up from $951 billion in 2025, has boosted stocks like Lockheed Martin, RTX, and Northrop Grumman. A recent $142 billion deal to supply weapons to Saudi Arabia, involving firms like Palantir, has further lifted the sector. The SPDR S&P Aerospace and Defense ETF is trading at $191.50 as of May 20th, 2025, up 39.6% from its yearly low of $137.09 and near its yearly high of $191.45. This outperforms the S&P 500's modest 0.3% gain. The sector's dual exposure to military and commercial markets adds resilience. Commercial aerospace is buoyed by a post-pandemic travel surge, with a backlog equivalent to 11 years of production for fuel-efficient aircraft and aftermarket parts. Companies like Transdig and Howmet Aerospace are seeing strong pricing power, despite tariff-related cost estimates of $0.5 billion for firms like GE Aerospace. Unlike tech, which saw sharp Q1 declines, defense stocks benefit from stable contracts and international demand. Road and rail's structural demand. The road and rail sector, tracked by the SPDR S&P Transportation ETF, is also outperforming, trading at $81.12 as of May 20th, 2025. Up 30.9% from its yearly low of $61.95, but below its yearly high of $95.62. This sector's strength lies in its critical role in logistics and freight, driven by e-commerce growth and supply chain reshoring. In Q1 2025, defensive sectors like utilities outperformed, but transportation has gained momentum in Q2 due to infrastructure investments and resilient demand. Companies like Goodyear Tire and Rubber benefit from reduced import reliance and increased demand for replacement tires as tariffs raise vehicle prices, encouraging consumers to maintain existing cars. Goodyear faces a $300 million tariff impact, but incurs 75% less tariff costs than import-heavy peers like Bridgestone. Federal infrastructure spending, including highway and rail modernization, provides a steady demand pipeline, unlike consumer staples or real estate, which face challenges from high borrowing costs and low consumer confidence. Tariff dynamics. Tariffs, a dominant theme in 2025, have a mixed impact but favor these sectors. The Trump administration's policies, including a 20% fentanyl penalty and a temporary reduction of baseline tariffs on Chinese imports to 10% for 90 days, have introduced uncertainty. Aerospace and defense and road and rail are relatively insulated due to their domestic manufacturing bases. Defense firms rely heavily on U.S. production, minimizing tariff exposure, while transportation companies like Goodyear leverage local supply chains. In contrast, sectors like materials, which returned only 0.2% in 2024 due to China's slowdown, are more vulnerable. The easing of U.S.-China trade tensions in May, including China lifting its Boeing ban, has further supported aerospace stocks. Market dynamics and investor sentiment. The S&P 500's top-heavy structure, with the Magnificent Seven tech stocks accounting for 33.5% of its market value, amplifies its sensitivity to tech sell-offs. In Q1 2025, the information technology sector fell 12.8%, dragging the index down. Only 36% of S&P 500 companies reported positive Q1 earnings, but defensive sectors like aerospace and defense and road and rail have outperformed due to their stability. The XAR ETF's modified equal-weighted structure reduces concentration risk, while XDN's focus on essential transportation services appeals to investors seeking refuge from volatility. Goldman Sachs forecasts a 10% S&P 500 return for 2025, targeting 6,500, but cautions that high valuations pose risks. These sectors' predictable cash flows make them attractive in this environment. Technological and workforce advantages. Aerospace and defense is capitalizing on innovation in AI, cybersecurity, and unmanned systems. Palantir's $142 billion Saudi deal highlights its role in AI-driven defense platforms. Road and rail leverages digital logistics and automation, with companies like CSX investing in smart rail systems to boost efficiency. Both sectors are addressing labor shortages through apprenticeships, with aerospace tripling apprentices in advanced manufacturing since 2021. These advancements contrast with slower-moving sectors like utilities, which face regulatory hurdles. In conclusion, U.S. aerospace and defense and road and rail stocks are outperforming the S&P 500's modest 0.3% year-to-date gain in May 2025 due to their resilience to macroeconomic pressures. Strong geopolitical and infrastructural demand, and insulation from tariff impacts. While the S&P 500 navigates tech-driven volatility and high valuations, these sectors offer stability through essential economic roles, domestic production, and innovation. Their ability to thrive amid global uncertainties makes them standout performers in a challenging market. I hope the much I've shared is helpful to both the person that asked the question and also every other market participant. Thank you.